Most people believe you have to choose between growing your wealth and keeping it halal. That belief costs Muslims billions in missed returns every single year. In the next few minutes, I'm going to show you exactly how to build a fully Sharia-compliant investment portfolio from zero. No jargon, no guesswork, and nothing that compromises your faith. The number one question I get about investing is simple. Can I actually grow my money without dealing in interest? The answer is yes, and it's more straightforward than most people think. This channel breaks halal investing down the way it should be explained, clearly, and without the jargon. Quick note before we start. This is education, not personal financial advice. Let's get into it. Halal investing comes down to two screens. First, the business screen. The company can't earn its money from things Islam prohibits, so no alcohol, gambling, conventional banking and interest, pork, adult entertainment, tobacco, or weapons. If a company's core business is haram, it's out. Second, the financial screen. Even a clean business can fail if it's drowning in interest-based debt. The widely used standard, set by a body called IUFI, filters out companies where interest-bearing debt is more than about a third of their value, or where interest income makes up more than 5% of revenue. Let's make that concrete. Take a supermarket chain. Selling groceries? Perfectly halal. It passes the business screen. Now look at how it's financed. If the company is worth $100 billion, its interest-bearing debt needs to stay under roughly a third of that. If it has borrowed $50 billion on interest, it fails the financial screen, even though selling food is completely permissible. That's the whole logic, what the business does and how it's financed. Two questions every single time. The good news? You don't have to check every company by hand. Islamic indices, like the S&P Sharia and Dow Jones Islamic, already do this screening for you. That's the shortcut we'll use in a minute. Before we go further, let's deal with the elephant in the room, because someone in your life has definitely said it. Isn't the stock market just gambling? It's a fair question, and the answer matters. Gambling is a zero-sum game of pure chance. Your win is someone else's loss, and nothing of value is created. Buying a share is fundamentally different. You become a part owner of a real business, real employees, real products, real profits. When you hold a compliant company for the long term, your return comes from that business creating value in the world, not from a bet. Now, can people use the stock market like a casino? Absolutely. Day trading random tickers on borrowed money is speculation, and it's exactly what we're avoiding. The approach in this video is the opposite: patient, diversified ownership of screen businesses. That distinction, ownership versus gambling, is the foundation scholars point to when they permit stock investing in the first place. One concept most beginners miss: purification. Sometimes a compliant company earns a tiny bit of impure income, say, interest sitting in a bank account. The Islamic solution is to calculate that small percentage and give it away to charity, keeping your returns clean. Many halal funds now report this figure for you, so it takes minutes, not hours. Here's how simple it is in practice. Say you earned $1,000 in dividends this year, and your fund reports that 2% of its income came from impure sources. 2% of $1,000 is $20. You give $20 to charity, and you're done. That's the entire process. For most beginners, the simplest halal portfolio isn't picking individual stocks. It's using Sharia-compliant ETFs. One purchase gives you hundreds of pre-screened companies, diversified, low-cost, and monitored for compliance for you. A few widely known examples: SBUS, which tracks large U.S. companies filtered for Sharia compliance. HLEL, a similar U.S.-focused fund. And for global exposure, there are iShares Islamic ETFs. I won't tell you which to buy. That depends on your goals. But the point is these exist, they're accessible through most brokers, and they solve the screening problem in one step. When you compare halal ETFs, three things matter. Who certifies it? Look for a named Sharia board that audits the fund. What it costs, the expense ratio, the small yearly fee, and what's actually inside it, which markets and companies you're getting. We'll go deep on exactly that comparison in an upcoming video. If you want to go beyond stocks, there are also sukuk, often called Islamic bonds. Unlike a conventional bond, which pays interest, a sukuk gives you a share in a real asset and its income. Instead of lending a government money at interest, sukuk holders own a slice of something real, say, infrastructure, and earn from what it generates. Same role in a portfolio, stability and income, without the riba. One thing before you invest a single rial, dirham, or dollar. Make sure you have an emergency fund first. A few months of expenses, kept safe and accessible. Investing is for money you won't need for years. Once that's in place, here's the structure. A simple beginner framework, a core of broad halal stock ETFs for long-term growth, a portion in sukuk for stability, and a small cash buffer. Younger investors with a long horizon often lean heavier on stocks. Someone closer to needing the money leans more on sukuk and cash. The exact split is personal, but the structure is the same one professionals use, just made halal. Start small, invest consistently every month, and let time do the heavy lifting. Consistency beats perfect timing every single time. Let's talk about why starting matters more than starting big. Compounding means your returns begin earning their own returns. In year 1, that's barely noticeable. By year 10, it's doing real work. By year 20, the compounding is often contributing more than your deposits are. That's why someone who starts at 25 with a modest monthly amount can end up ahead of someone who starts at 35 investing double. I'm not promising you any specific return. Markets rise and fall, and anyone who guarantees you a number is someone to walk away from. But the math of compounding is exactly why every year you wait is quietly the most expensive year of your investing life. 5 mistakes to avoid. 1. Assuming any fund with ethical in the name is halal. It isn't. Always check for Sharia certification. 2. Forgetting purification and letting impure income accumulate. 3. Chasing hype instead of building a boring, diversified portfolio. Boring is what builds wealth. 4. Trading on margin. Margin is borrowed money from your broker, and you pay interest on it. That isn't a gray area. The interest is riba, and on top of that, leverage can wipe out your account in a single bad week. Cash only, always. 5. Waiting until you know everything before you start. You will learn more in 3 months of actually investing a small amount than in 3 years of only watching videos. Start small, start compliant, and start. So what do you actually do this week? For steps. 1. Confirm your emergency fund is in place. 2. Open an account with a regulated broker available in your country that gives you access to Shariah-compliant ETFs. Most major international brokers do. 3. Decide on a fixed monthly amount you genuinely won't miss, even a small one, and commit to investing it on the same day every month. 4. Choose your halal core using the 2 screens and the certified funds we covered, and then let the routine do the work. That's it. No charts to watch, no timing to get right. Just a clean system that runs every single month and stays halal from the first dollar. That's the foundation of halal investing. In the next video, I'll break down exactly how to check if a specific stock is Sharia compliant in under 5 minutes. If this helped, subscribe so you don't miss it, and drop your questions below. Invest well, and keep it halal.